Here's a market update for Q1 of 2025. It's January 5th today. So it's been about a year since my last video. I've been pretty active on Twitter, but not on YouTube videos. So today we will have a summary of my 2024 performance. We'll look at a macro update of the US and global economies for January 2025. Our key question will be, have asset prices topped? We'll have some predictions for this year and some advice on ways to be defensive with your portfolio to protect your profits. Not financial advice. So I had a very good year in 2024 from January to December period, the last 12 months. The big home run was Microstrategy, up 418% over 12 months, and even more so from my buy-in in 2023. I got in at around $55 a share, and it went all the way up to $530. It's pulled back to about 300, but still up 418%. My other big winner was Palantir. I managed to get in the 9 to 11 US dollar range, and we hit as high as 80 US dollars this year, so I'm up about 391%. Bitcoin had a very good year, up 122%, and even Tesla rallied in the second half of the year, up 72%. The other bet I made was Sterling Infrastructure, STRL. It's up 126% in 2024 and about 500% in the last few years. I had a few small losing trades, although with very small positions. AMD and Enphase did not work out very well. I sold them quite quickly though. Anyways, some small losses there. I think the big calls I made that allowed these returns was I was heavily invested in the above positions and called that a recession would not happen. And then, of course, a Trump win. I had called that in January of 2024 that I could see he was going to win the primaries and that Biden was not strong, and that the media was saying Trump was going to be put in prison and all of this other negative news, but I could see that that likely was not going to happen, and there was a very good chance Trump was going to win, and that this would be good for markets. So some discussion questions. Have asset prices topped? We've had 2 very good years. And some people are saying that this has been too much and we will have a down year in 2025. Is that correct, or are we going to go higher? What are some of the major risks we'll look at in 2025? What is the bullish argument? An outlook for Bitcoin and crypto in 2025? And then what are some ways to protect your gains if you are in profit? So a catch up on where we are with the S&P 500. As of Friday, we closed at 59.42 on S&P. This is the chart looking back to 2009. You can see the green 200-week SMA, simple moving average, and that we have not gone below that except for the COVID crash down to 2186. Other than that break during COVID, we've held the 200-week SMA since 2012. And you can see we're up quite a bit. Reminder, in October of 2022, when we were at 3,500, everyone was bearish. About 80% of analysts were bearish, and they turned out all to be wrong. We've had an amazing historic run since then. So for a little over 2 years, we've had a run up to the 6,000 level. Then the question is, now that everyone is more bullish, I'm not sure 80% of the market is bullish, but let's say more than half are. And does that mean we should be contrarian and again bet against the consensus and look at whether the markets will go down this year. Certainly you want to be cautious after you've had 2 very good years. The markets are expensive. I think everything's expensive. Real estate is expensive. Gold is expensive. Crypto's come up. Stocks are expensive. You can see from the Shiller PE, historically expensive. And so the question is, do we have another good year, or do we get a negative year in 2025? And we'll look a bit more there. A lot of people are calling 6,500 to 7,000 by the end of 2025, which would be about a 10 to 15% increase from where we are today. One of the key bearish arguments for a weaker 2025 is that inflation will return to higher levels and prevent the Fed from easier monetary policy, which means stocks will sell off. This is the historical inflation since 2004. I think we're at about 2.6% on this chart, but you can see we're quite a bit down from the 2021-2022 high of almost 10%. We've come way down below 3%. To me, it's not a major threat at the moment, but it is a risk to watch. There's some fear that the Trump administration that comes in will be raising tariffs and be isolationist to the extent that they deglobalize the world somewhat, and that this would raise prices on imported, exported goods. I'm not convinced of that yet. I think Trump will be a pro-business and try to push prices down. Whether he can balance a America First policy along with global trade and cheaper global prices is yet to be seen, but I think there's a very good chance he is successful in this regard. It's also important to know that Trump will want to have a buoyant economy and will be, creative and adaptive, so that if some of his policies are not working, he's the type of person that will correct them. In any case, I don't see this inflation chart as particularly a big threat at the moment. This is US real GDP, real gross domestic product, adjusted for inflation. You can see it's continuously up and to the right. The last 2.5 years included, except for that little dip in COVID, the chart is up and to the right. It shows that the aggregate growth of the US economy continues to grow irrespective of unemployment rates or other factors. A big reason for this is government spending. I think the US government spent $6 to $7 trillion last year, just like they did the years before, and all of this circulates into the economy. And you also have the US population growing. When we're speaking of the US economy, and talking about whether asset prices are going to go up or down, we need to focus on the aggregate, meaning including population growth, including government spending, and all of these factors combined. Looking at GDP, real GDP by quarter since 2020, you can see we've only had one negative GDP result, which was the Q1 of 2022. Other than that, we've had positive real GDP continuously, in particular towards 2.5% to 3%, including last year. And so a 3% average per year is very significant, and it's relatively strong. And this is a major reason why asset prices keep going up and up and up. Likewise, US house prices continue to rise up and to the right. You can hardly even tell we had a COVID crash or anything else. in terms of negative crashes in 2021 or in 2020, and that U.S. house prices had a small, very small dip, but continue to rise. Of course, this is the major asset that determines the net worth of your average U.S. household, and it has a wealth effect, so that as people's houses go up in value, they feel richer. Americans' household wealth has soared since the pandemic, and this again is up and to the right. So you can see all of the data I'm presenting has one thing in common: it's going higher and higher and higher. And obviously these all correlate to one another. Higher housing prices lead to more confidence and higher stock prices. And you, again, a growing U.S. population on top of average household net worth increasing rapidly. Baby boomers still holding somewhere between 80 to 120 trillion in net worth. Baby boomers are between the ages of 65 and around 80, and they're spending. Again, this amount of savings keeps rising as house prices and asset prices rise. So the number is increasing despite the boomers being retired and spending. A summary here from Tom Lee at Fundstrat. He just re-emphasizes again and again in his interviews that U.S. baby boomers' savings are simply enormous. He's estimated 120 trillion US dollars. At current interest earnings, that's about 7 trillion US dollars a year, not including the principal. And then he mentions that, well, US annual GDP is 25 trillion. So 7 trillion divided by 25 trillion shows that 28% of US GDP is represented only from the interest on boomer wealth. Again, not the principal, just on the interest. And so this is an incredible boost to spending in the US. And it's why you have such high corporate profits and GDP growth, because of the wealth is compounding and compounding and compounding. US dollars in money market funds is now at almost 7 trillion. I believe when I looked at this last year, it was at around 6 trillion. So we've added another 1 trillion US dollars into money market funds, which are essentially cash equivalents. They're earning 4 or 5%. So again, it's money earning money, and some of that gets spent or reinvested into things like stocks. If you're bearish for 2025, you must be arguing that there's going to be some sort of crash, and that the crash will not be bought by all of this cash on the sidelines. And I'm not convinced that that would be a likely occurrence this year. This chart is aggregate US payrolls, so it's total number of people employed, except for farm payroll. And you can see it's consistent with the other charts I presented. It's up and to the right and hitting new all-time highs. So certainly we need to watch the unemployment rate as a percentage of total people in the workforce, but you also should not overlook the aggregate or total number of people employed, because you have a growing US economy that is very robust, and that's why you have aggregate spending increasing. And so the total number of people working is more important than the percentage of people unemployed, in my opinion. So here's the unemployment rate in the US. It's around 4.2%. We have not had the recession or the spike that the bears have been talking about for 2 years. In fact, we're still at very historical lows if you look back all the way to 1950 here. So again, on aggregate, we have more people employed, and as a percentage of the workforce, we have very low unemployment. Back to our chart of the S&P 500, when we're looking at all of these trends going up and to the right, real GDP, aggregate employment, cash on the sidelines, U.S. housing, a Trump administration coming in that's positive. We'll talk about this a little bit more. But you can see it would be very reasonable for us to go up another 10 to 15% towards a 7,000 tick on the S&P 500 unless there's a major event. And we'll look at the bear risks in a little bit. But unless we have a major event to disrupt these trends, there's just more than enough cash to push us higher this year. So let's go deeper on some risks in 2025. Asset prices are historically high. We'll look at the Shiller PE in our next slide. There is a risk that inflation could return, although I think this is low. Of course, there's always the risk of a major war, something larger than what happened in the Ukraine or the Middle East. Bond market collapse is possible. It could be that the Trump tariffs and isolationism have a negative effect, although I don't think that's going to happen. It is possible. We could have some deglobalization. We could have BRICS become a real thing. And of course, there's always the unforeseen events that we can't predict in financial markets with banks, etc. But again, it's hard to predict these, and you're best not betting on them as likely. Here we have the Shiller PE level, which shows that stocks are historically expensive. You can see at the far right, 37.74. So this is since 1880. It's quite a long chart, and it shows stocks are expensive at the moment. So digging deeper into geopolitics and major wars, so it should be noted that both the Russia-Ukraine wars and the uprisings in the Middle East were very large events historically, and yet they did not interrupt stock gains the last 2 years. So Russia was on the doorsteps of Europe fighting with Ukraine. There's been several 100,000 people killed with a major nuclear power, and yet the markets continued to rise. In the Middle East, the Israeli attacked both neighbors, both the Gaza Strip. They had a kinetic interaction with Iran and Lebanon. And so with both of these, the stocks and asset prices continued to rise. You could argue that America is becoming increasingly a safe haven when these things happen, and that actually the U.S. asset prices, or at least the stock market, will actually rise when these things happen, if only because the U.S. has a much better self-sufficient stock of oil. Previously, when you had outbreaks of war in the Middle East, there would be a risk or threat to the oil supply to the U.S., and therefore the U.S. economy would also crash or pull back when you had major events. This is no longer the case. The U.S. is self-sufficient in terms of oil, and so actually the U.S. is more of a safe haven. Both the U.S. dollar and U.S. stock markets are arguably a flight to safety now when you have wars. And so my guess is that looking forward, it would seriously take effectively a World War III to threaten U.S. asset prices. And in fact, the smaller wars make the U.S. markets even more attractive. So that's something to think about. The other issue is China. Arguably, Chinese power and foreign the ability to project their power globally is falling as their economy weakens. They have demographic issues with far too many elderly people as a proportion in their society. And they've had issues with their real estate markets and their banks. And so a weaker China obviously means a stronger US. And once again, more confidence in the US stock market and asset prices instead of China. If the Chinese economy is weak, there is less likelihood that they would, for example, attack Taiwan, in my opinion. And so in that regard, China being weaker is bullish for US asset prices. In turn, Europe is very weak. There's a lot of bad leadership in France. The UK has had many problems as well. Mainland Europe, Germany is underperforming. And you have the European Union being a major brake on the ability or sovereignty, let's say sovereign power of countries to correct their economic woes. And so having only one currency amongst the European nations means you cannot have the sovereign policy decisions to alter your interest rates or your currency to respond to sluggish growth. So Europe is weak. Similarly, Canada and Australia have been quite weak. They have very expensive real estate markets that did not burst in 2008, and so you have very expensive home prices which impact the consumer and slow domestic spending. Also, they've had bad woke governments in place. Hopefully Trudeau is going to resign this week, but they've been horrible for the economies. Lots of immigration, slowing down and putting pressure on, slowing down growth and putting pressure on government resources. And finally, you hear a lot about BRICS, so Brazil, Russia, India, China, and South Africa would make up the BRICS moniker, and it's regarding countries starting to trade outside of the US dollar using things like gold for oil or even Bitcoin or other currencies outside the US dollar. I really don't think this is a near-term threat. If anything, the US dollar and US dominance is increasing. We see the US dollar very high recently. And once again, I think it's a flight to safety currency. And that combined with US economy outperformance compared to China and Europe means the US dollar is getting stronger and stronger. And as I've said before, about 80% of global trade is denominated in US dollars, so you have a massive liquidity advantage to the US dollar. Certainly, there could be a movement against the US dollar and US financial supremacy, but I don't think it's a near-term threat. Definitely would be a surprise if this happened in 2025. I would argue the trend is almost the other way, with the threat being that the US dollar gets too strong and the US economy gets so strong that it starts to wipe out its competitors in the second and third world countries, and that causes sort of a wrecking ball effect. There's a theory called the dollar milkshake theory, if you'd like to look into that argument of the US dollar actually being a threat, not because of its weakness, but because of its strength. So that's an interesting research point if you're interested in that. Some bullish arguments here. I think the biggest one is the Trump win, and I put Trump and Vance together here because it seems to me the market might have priced the next 4 years of Trump into some of their valuations, but I think it's very likely that Trump is successful this term and that J.D. Vance or another Republican candidate wins in 2028, so that we actually have 8 years of a Trump-Vance presidency rather than just 4. The issue there is that you then have a very long period of low taxes, pro-business, pro-growth policies. And the significance of this could be extremely positive for risk assets. It's been a long time since you had a government that was this pro-business, pro-crypto. And we are also reacting to a very poor, in my opinion, Biden presidency, and a Trump that was sidelined even in his first term, where there was a lot of people against him. And I think we're going to get the other side of that momentum, meaning we're going to get everything possible out of Trump and Vance and his administration, including Elon Musk and Vivek Ramaswamy. And some people are saying that all of this has been already priced in, but I disagree. I think we're going to be surprised to the upside with how much Trump is going to be able to get done and how aggressive they're going to be with deregulation, trying to bring down oil prices, crypto, and a very pragmatic pro-business momentum. That starts in about 2 weeks. My second point is that U.S. boomers get richer and richer despite their spending. I showed that stat from Tom Lee that even just the interest on their investments is generating around $7 trillion a year without touching the principal. So we're getting a compounding effect on U.S. wealth. Third point here is the U.S. economy is actually strong, both in real and nominal terms. Part of this is because Europe and China, Asia are so weak. They have bad governments. They have smaller economies. China has its own problems with demographics. Europe has its problems with its just horrible governments in the West, immigration problems, and the like. And so the U.S. is actually the flight to safety and flight to growth. It's both. Not only is it the best performing economy in terms of growth, but it's also the most pro-business, and in many ways it's an escape for rich Europeans and Asians to invest in the U.S. economy and get the returns they need. Also the U.S. dollar strength. They're getting not only the appreciation in the U.S. assets, but also the U.S. dollar denomination versus their own currencies. Okay, other points, AI productivity. We hear a lot about this, but I think it's the real deal. I think corporate profits are going to go up because their productivity is going to improve. There may be layoffs and unemployment as a consequence of the AI tech impacts, but it will result also in more profitability for software companies. And then finally, Tesla, full self-driving and robotics. This is not just about Tesla share price going up. Full self-driving, it may take 5 to 10 years to fully integrate into the economy, but it will have massive productivity gains. Everything from the supply chain to commute times to reduced accidents and traffic. We can't even imagine the implications of having driverless semi-trucks crossing the U.S. While the driver sleeps or the manager sleeps or there's no driver at all. So it's not just about robotaxis, it's about full self-driving for the entire supply chain eventually. And then robotics is even bigger. So once robots are in the factories, the cost of capital or the cost of labor goes to zero, and it's going to be mind-blowing how much this improves productivity. So going deeper on Bitcoin, you can see we're at about 98,000 today. We've had a good year, but everything is saying we're going to go higher. This is the monthly chart. You can see we're in a bull trend with being above and holding above the 10-month simple moving average. We had our consolidation earlier in 2024 where it went from around 73,000 down to 57,000. We had a 10-month consolidation. We've now gone up significantly to a new level. and the chart looks very good. I'll go over the list of reasons why I think it's going to 150,000 to 200,000. So the easiest one is just the historical trend, the 4-year cycle, and we are in a peak year in 2025. The last 3 times we've been here, we've gone higher. We've gone a multiple of the previous cycle's all-time high, which was at 70,000 in the last cycle. So if we even just do a 1x off of the 70,000 that was hit in 2021, that takes us to around 150. A 2x would take us to 210. The Bitcoin analytics, everything from realized gains to the Meyer multiple to the Puel multiple, all of them are saying we have higher to go and significantly higher. So that's all supportive. ETFs launched in February of last year and are the greatest ETF success story in the history of ETFs. We've had, I think, 100 billion go into the ETFs, and then also Microstrategy has doubled its Bitcoin holdings from around 225 up to 450,000 Bitcoin just in a few months. So the buying is steady and very impressive. We have the FASB rule changes, which should facilitate corporate adoption. Basically, your Bitcoin counts as a tangible asset that's updated every quarter, and so as Bitcoin rises, this will impact your shareholder value and your net income, which will encourage and incentivize companies to hold Bitcoin in their strategic reserves. And that's what MicroStrategy is doing. Of course, you should see other companies incentivized and rewarded to do so. The Trump administration had ran the election with a pro-Bitcoin policy. The bears are saying that this they won't follow through, but it's very clear from all of the press conferences and releases and interviews with people in the Trump administration, including his sons, Eric Trump, very vocal, that they are going to continue, they are going to fulfill a Bitcoin promise, whether that's a strategic reserve or deregulation and pro-Bitcoin policy, pro-Bitcoin mining. All of these are saying they will deliver on what they've said. Nearly every member of the Trump administration actually owns Bitcoin and has been talking about it positively. Fiat and the bond market are just unattractive competitors for Bitcoin in my mind. You know, ongoing inflation just tells people they need to get into a more harder currency. The bond market is about 100 trillion globally, and it's unattractive. It's a melting ice cube, as they say. I think the next might be real estate, where real estate has become so expensive in the US and globally that the yield, the real yield on rental properties is not very good, somewhere around 5 to 10% at best. And therefore, we then have a third global asset class that is less attractive compared to Bitcoin. So fiat cash, bonds, junk bonds, even regular bonds from first world nations, and then real estate that are not performing well. And this is a benefit to a Bitcoin that's rising something around 50 to 100% per year over 16 years on average. And then I'd add the Bitcoin market cap is only 1.9 trillion, whereas you have gold at 17.8 trillion and global assets of 500 to 900 trillion. So it's still a tiny market cap. It's just getting to the point where it's liquid enough to attract major interest from sovereign wealth funds or even nation states, and that process is happening. You're also seeing Bitcoin being introduced into bonds, what were called, I forget the term I was using, but putting small percentages of Bitcoin into US dollar bonds as a way to increase the returns without increasing the risk. And so I've been on Twitter saying that Bitcoin disrupts junk bonds, certainly, and also even regular bonds issued from Western countries that cannot keep up with the money printing, and that Bitcoin infused bonds is something that's actually happening right now. If you're bullish on Bitcoin, you certainly will need to be bullish on Microstrategy, as it is a pure proxy with upside and leverage. And so Microstrategy has almost 500,000 Bitcoin, and there's no signs that that is going to slow down. Even last week, there was a new $2 billion preferred share issuance by Michael Saylor. And so if anything, he's accelerating his aggressiveness with acquisition rather than slowing down. So they're at almost 500,000 Bitcoin. The FASB rules I've discussed, this will affect their Q1 of 2025. So you will see a massive headline showing them with billions of accrued, what would be termed net income based on their Bitcoin gains. So Saylor is issuing multiple different financial instruments, different types of bonds, preferred bonds, convertible bonds, and what they call an ATM function, which allows them to raise funds against shares. Now, the bears are saying, well, that's diluting the share count. While the share count is increasing, the Bitcoin per share is rising rapidly despite that share issuance. So if you're holding MicroStrategy shares, your Bitcoin yield, as they're calling it, is rising. So if you're bullish on the Bitcoin price, you need to be bullish on MicroStrategy. With a Bitcoin price around 150 to 200,000 US dollars, you will easily see MicroStrategy go to anywhere from 600 to 1,000 US dollars or higher, based on the leverage and the ability to issue shares and buy Bitcoin. And so I'm quite bullish on this as well. So my predictions for 2025, this could be by the end of the year, December, or it could be these targets are hit earlier in the year and you could have a sell-off in the second half. But in either case, I think sometime this year, we're going to see the S&P 500 between 6,500 and 7,000. So that's about a 10 to 15% uptick from today. I think you'll see Bitcoin at a conservative 150,000 to 200,000 US dollars sometime this year. Again, it could be earlier in the year or it could be later with a sell-off. Assuming you believe Bitcoin is going to 150 to 200, you have to be bullish on MicroStrategy. My next slide will cover that, but basically we have FASB rule changes, which means the Bitcoin on corporate balance sheets counts as net income or revenue, which will show MicroStrategy actually having a low PE vis-a-vis their gains in Bitcoin. And then of course they own 500,000 Bitcoin, and that number is rising. And so if you're positive on Bitcoin going up, it's a no-brainer that MicroStrategy will outperform this year. Palantir, although it's expensive compared to last year, it will continue to see rapid growth. It will be a popular stock. We might get up to about $100. It's at about $75 now. It is expensive in the short term, but I think people are buying Palantir looking ahead maybe 5 to 10 years, where it's likely going to be worth about $1 trillion or more. So it's a matter of patience, and I think dips will be bought very aggressively, so it's going to be hard to get it much cheaper than $75. And then Tesla, FSD, and robotics, the market is already starting to price this, I think. We'll see, but it should have a positive year, and these are my main predictions. Okay, my final slide here is ways of protecting your gains. So certainly I could be wrong, just like anyone can be wrong. We could have a massive crash in 2025, and I would certainly lose a lot of the gains I've accrued the last couple years. And so here's some tips on ways of protecting your gains. Of course, the easiest one is just to sell into cash, perhaps 10 to 20% of your portfolio. Of course, there are tax implications for that, and that's an argument to not do it, but it certainly instantly diversifies you. You could be moving from big tech if you have risk in companies like Tesla and Nvidia. You could sell some of that and move into small caps, which have much cheaper PE ratios. Some other options would be to sell covered calls against your shares. You can look into that, or buy put options. The selling of covered calls generates income against future gains. The buying of put options would be a cost. However, it would protect your downside if there was a major crash. So you could do put options at, let's say, 25% below current prices, and if we did have that major crash, you would make money below that 25% strike price. Another one is trailing stop losses. You could just have sell orders that rise as the prices rise this year and try to time the market that way. And then finally, portfolio diversification. So if you do have a large portfolio and you'd like to protect it, the best way is to diversify. A simple bucket strategy would be to break it into 5 buckets of 20% each. One would be gold, one would be stocks, one might be cash, one might be crypto, and one could be commodities, for example. So you can split it up. The problem there, of course, is you instantly condemn yourself to have less returns and lower returns, because most asset classes are not performing very well, and so that's the trade-off. So one is taxes, moving out of your positions, and the other one is you're moving into asset classes that may perform more poorly. So if you're willing to do that trade-off, it's a good idea. Me personally, I am in fairly significant profit positions in crypto and in shares, in stocks, and so I will be selling slowly as we move forward this year. I think Q1 I'll start selling a little bit and move likely about 20%, sell off about 20% of my position. The reason I wouldn't sell more is tax implications, but also that I am still, let's say, cautiously bullish on the markets. We'll see how it goes. If there's a blow off top where we see Bitcoin at 200,000 or higher, of course I would sell off more and not less, because there would be an indication that we would probably have a pullback of perhaps 50% off of extremely high levels in crypto, and so I would sell more. And one final comment to the bears that are either have sold already or planning to sell. Certainly they will be right again eventually, and it could happen this year or next, simply because we've had so much of a run-up. But just a reminder that you have to make 2 good decisions when you are a bear and selling out of the market. The first is the timing of when you sell, but even more difficult is when to buy back in. And so you frequently will have people taking profits and selling, but not knowing when to get back in, and the market leaving them behind. So as an example, let's say someone sells the market at 6,000 or 6,500 and feels good about themselves when the market goes down 10 or 20%. But they have to then decide at what price will they buy back in, and will the market go down to that price. So you can get what's called being shaken out of the market, where we go to 6,500, people sell, the market drops to let's say 5,800, those people don't buy back in, and then suddenly we're at 7,000. So those people are stuck in cash with a major tax bill next year, and have been shaken out of the market and are forced to buy back in at, let's say, 7,000 or higher. So be careful when you sell, that you need to also make sure you know at what price you're going to get back into the market, and then you have to hope you'll be right about that. Okay, that's all for today. Thank you very much, and good luck in 2025. You can find me on X, Twitter, @GreshamsLaw7. Thanks.